All right, so week 10. Yeah, we're kind of getting to, we're going to be talking about mutual funds. And these are where you're probably going to really generate, well, you may have some real estate, but the mutual funds are probably where most likely you're going to be investing most of your money and making most of the money through, out your financial career, your financial life. It's important that we talked about stocks and bonds and other stuff, but mutual funds are just so easy and they're ubiquitous. They're everybody's very comfortable, including your employee, with their match programs and things like that. And but mutual funds are they're nothing that special. They're a great product, but if you understand a little bit about stocks, which are equities, ownership position in a corporation or whatever, you can understand mutual funds quite well. So let's look at, again, some people are going to be hesitant to want to get in, stocks and that sort of stuff. And I'm sure crypto even freaks people out more. But you kind of got to get off the porch in terms of investing, especially when you're young, and realize that in spite of, the news that's out there sometimes, there's really nothing that's going to match, the returns that you're going to get. Newsworthy things are every time there's a huge crash. This was back in 2007, and oh God, sell everything. And there are people who maybe got out at the bottom, but you can look at the time frame here. This is, going back from the turn of the century, like the other century, 1900, up to this stops in about 2016. But anyway, you can see where you're ruined. You've lost everything. Oh no, you haven't. All you got to do is just not do anything, and come out the other side 2 years later, and then within 3 years you're back in a positive zone, and by staying invested, you're participating in this whole run. So, the Great Depression, yeah, it was pretty significant, especially compared to the 2007 item. But, yeah, it's not a complete linear relationship. We had a dot-com bubble. We had different stuff. You can go back and look at historical events. But that's the power and the beauty of charts, is it doesn't take a lot of intelligence to go, oh, wait a minute, this is a nice positive vector. And you have to be careful with charts because you have a logarithmic nature. You have, the numbers obviously are getting quite small up in here, but that's, anyway, as long as you know the parameters of the chart when you're looking at it. But nothing, erases that positive momentum. Just to kind of reinforce that, here is, so when they say all time, what they're talking about is from around 1990 or so on up. This is the Dow Jones Industrial. So Dow Jones Industrial, you could invest in that directly if you wanted to, just in a index fund, but probably wouldn't be very useful. The Dow Jones, what it is when people, pundits or news or people in general want to go, how's the market doing today? Well, it's made up of a whole bunch of individual component stocks. So one stock may be up, the other one may be. It's hard to get your arms around the whole thing. So they have some. The Dow Jones, for example, is just a collection of stocks that represents sort of a wide exposure across the market, so that you can tell the general direction of the market and what's going on. But anyway, so the DJI, right? Again, you can see that positive attribute. So way back in 1995, market was trading for about 5,000. So that's up about 9 times. You can see your wealth being created. Now again, the bad guy here is inflation. Inflation is also increasing, so you got to be able to outperform inflation. Then again, I like these kind of charts where they have the volume at the bottom. You can see the market fell out of the bottom, or you know, here's 2007. You can see that spike in the market. So they were extremely bullish. That was a green spike here, but here this spike, this was a large red down spike. Anyway, we could go on like this all day. Here's the Federal Reserve of St. Louis. So they just produced the chart. But again, what I'm trying to show you is that this isn't all just, commercial data that's from some .com. These are derived from government statistics. This one is of the S&P, so the S&P 500, Standard & Poor's 500. Kind of like the Dow Jones in terms of a broad index, but a little more weighted to stocks that you'd want to be involved in. And this one just goes 10 years. And so it's going from 2,000 to 7,000. So not bad. We had COVID back in here, maybe recovering from COVID, but they goosed it with a lot of money from just dumping money, which, kind of spiked the inflation as well. Here is actually the recession, so this was the COVID-induced part. Other people are, they're like, well, I like gold. I have some gold, not much. Not a huge proponent of it, and if I would have given you this chart last year, I would have used this chart to say, this is why you don't want to be involved in gold. Because it wasn't flatlining, but, from 1,000 to 2,000, the other one's going 9x, 9 times. Gold has had a pretty good run in this past year. If you bought just this past year and jumped in, that's pretty cool. There are good things about gold, and people get, very wrapped up about, the physical nature of it and all that, and, some sort of doomsday scenario, but I just don't see it. My problem is that, if we're in some sort of apocalyptic scenario, Mad Max kind of thing, and I'm trading gold at the gas station to get fuel, well, I better also have some guns. If we're really in that sort of scenario and it's completely lawless and I've got a big stack of gold, gold is nice, but the person with the guns is going to end up with all the gold very quickly. And it's just whatever. It's not a scenario I can envision seeing. So there's maybe some good reasons to hold gold, but I'm not sure that is necessarily one of them. Because you have the custody factor that it either needs to be held by you, or if you're having held by somebody else, then you've kind of lost that physical element. And then it's kind of not far-fetched, but the price or the supply of gold is not quite limited, because if gold prices go up, which they do, there's going to be a lot of mining activity to, obviously it makes more sense. It's economically, there's a lot of mines kind of on the sidelines that are maybe economically feasible, but when gold prices spike, now they're coming into production. So a greater supply may drive the price or flatten it or whatever. And then to be completely irresponsible, I'll show you a Bitcoin chart. Now Bitcoin, it's cyclical, so it goes up and down and up and down, but you can't argue this from, basically zero to, we're up. I don't think we ever got to 108 or something like that, but pretty damn high. So not the thing to put all of your money in. Obviously, Bitcoin's kind of the big boy. There's a term of Bitcoin maximalists, people who are involved in cryptocurrencies, but they'll only do Bitcoin. And tell you the truth, those people, it kind of works out for them, or at least it has, because there's the whole other sector of crypto are coins that may have like some sort of use case, but you talk about volatility, that the altcoins, and there's a lot more scams going on in the altcoin world. Bitcoin's kind of the big boy, and just sort of, it doesn't just trundle along. I mean, there's a lot of volatility, and in my mind, there's kind of enough volatility. I have a bunch of altcoins, but I'd probably be better off if I had nothing but Bitcoin and be a Bitcoin maximalist. But anyway, I'm not saying to this isn't interchangeable with stocks, interchangeable with mutual funds. No. Should you have some exposure, 5-10% to Bitcoin? That's probably prudent. But it's like anything else. If you have a investment that does really well and you have this balanced situation where you just have 5 or 10%, then if that fund or stock or investment does really well, you get out of balance. I had a company I was working for, and they insisted that part of the terms and conditions of their match and their retirement and all, you had to be in mutual funds, because again, they were trying to, make you responsible. They don't want you out randomly speculating on individual stocks because, they thought that was a bit reckless. And this isn't uncommon for companies to sort of give you a selection of mutual funds that you can choose from and not give you full independence. Anyway, they opened it up at one point and they said, okay, 50% of your account can be in a self-directed IRA fund. Self-directed meaning I could choose the stocks and do all that. So I did. I took 50% of the money and I put it in the self-directed account, and I was killing it. And so every year they'd come back to me and they'd say, wait a minute, you're, got 75% in self-directed, and, the fund where you're supposed to have the other 50% in the regular mutual fund is now down to just 25%. And so I'd have to rebalance every year. And, what was obvious to a casual observer is that, their fund was obviously not performing as well as what could have been done by somebody who was watching it and perhaps, maybe, able to take a little bit more risk, or at least realize that it was a very bullish market, meaning bullish as in a very positive market that's going to go up, and it was time to jump in and not be as restrained. And anyway, so you have bears, and then you have bulls. Bulls are the bullish, the positive market, and the bears mean that they expect markets to go down. So, okay, enough of that. I think, you compare those charts I just showed you to your savings account trending along at, a couple 3% or something with inflation, and, it's like a horse race between it and inflation. What's going to outperform? And at best, you're treading water, and it's just not going to generate wealth. Your money is not working hard enough for you. So, okay, background on mutual funds. We'll just start at the basic here. Funds that sell shares to individuals invest in the proceeds in stock. Most mutual funds are based out of stock. Now, they can be also comprised of bonds. They can be mixed, all that stuff. So mutual fund is just sort of the broad category of this type of investment. Now, why would you want to do that? Because, again, you don't have to pick individual winners in here. You don't have to pick individual stocks and potentially be wrong and have these huge swings. Maybe you go across an entire sector, or you go for a whole indice like I was talking about. You invest in the whole S&P 500, the whole Standard & Poor's. Anyway, there's lots of reasons for that. The other thing about a mutual fund is that there is, in an index fund, there's not a whole lot of management and stock picking going on because they just pick the index and they hold it. But if it's a highly, managed fund with somebody in there making trades and doing short sales and doing all types of stuff like that, then you've got somebody doing that, and supposedly this person is proven, has some expertise, and is getting results that outpace just the index funds or the market in general. So you again, most of you are going to be, either doing traditional lifestyle things, raising your kids or doing sports, out hunting, doing whatever, and maybe not watching your investment portfolio. And with a mutual fund, you've kind of hired that out. You have a professional who is taking care of that for you, and things are kind of on autopilot. Now, you want to check in every once in a while, and again, you don't necessarily want to obsess over it, but every 6 months to a year, you want to look at the fund's performance and see how they're doing. And again, the portfolio manager here, he may have a longer term plan, he or she, and so mutual funds are meant to be kind of bought and held. They're not meant to be actively traded with you jumping in and out. Sometimes they'll have measures, procedures in place to prevent you from jumping in and out. You'll be limited to the number of trades, or if you trade in and out, they notice that sort of behavior. They don't like it because they are trying to figure out how many assets they have under management and make investment decisions on that. And if people are jumping in and out of the fund, it kind of disrupts their strategy. So anyway, so mutual funds are it's good to know all about the other types of investments, but for the majority of your wealth, your investments, they'll probably end up in mutual funds, which is just fine. So super easy, user-friendly, small initial investment, diversification that I talked about. So mutual funds are just, it's just super, you can put in $100 a month, and they'll usually have a minimum where you need a $2,500, initial investment. But typically that's all waived if you set up some sort of regular deposit type thing. And this is where the wealth grows, because you set it at 10% of your income, or a few hundred, 500 a month, whatever it is, you allocate your investments, and then you forget about it, and it just builds on its own. So that portfolio manager, specific investment goals, there's a thing called a prospectus that are kind of the rules of the road. There's some marketing in there, but it is a legal document, and it sort of tells what that fund manager is going to do, where they're going to invest, what they're going to do, and they got to stick within those rules. So, you don't want to find out that your investment fund decided it was a great idea to go invest in, Cambodian something or other, but you find out, you've lost everything because you got in some sketchy investment. Nope, if it's not in the prospectus, they can't enter those sectors. But anyway, we'll look at that. Net asset value, because this isn't as big a deal as it used to be, because obviously the power of computers and quoting and all that stuff, coming up with a stock price is pretty easy. But when you've got a whole collection of stocks under one mutual fund, and the actual amounts to be able to calculate the net asset value, the total of the assets under the mutual fund, when there's a whole bunch of different component stocks, would be a little more involved. And so typically it was just reported once a day. Now it can be reported all the time, in real time. But anyway, net asset value it's equivalent to the individual stock prices weighted by what percentage they comprise of the overall portfolio. But anyway, so you won't see a stock price, you'll see a net asset value for a mutual fund price. Load versus no load. Yeah, there's no reason to be paying a load. The only reason you would pay a load is if somebody comes up to you in some sort of sales pitch and says, hey, this is the program, we'll bring you out to dinner, we'll do this, they'll do some marketing and they'll get you to invest, and obviously that salesman wants a commission. You don't need that. Um, you sell directly to investors, do not charge a fee. The problem is if there is a load, it's worse than it appears. Let's say that they charge a 10% load up front. Well, I'll show you some examples, but that load comes out of the front end. We talk about how even a small amount of money invested over a long period of time can grow into a lot of money. Well, if that load comes out of the front end, that money they took as a commission is pretty damaging, because if you had that you know amount of money in your initial investment, that's the money that was going to grow the most. So loads can have a significant impact on investment performance, and there's just no need for it. So here's an example: no load fund. So this one, no load. Here's a load of $200. Not doesn't seem like a huge amount, but here's the end of the year. He made some money on the whole thing, so amount invested 5,000. So the whole amount's in there. Divided by $20. He's up 5,500. He made 10%. Bada bing. Here, invest whatever 4% went for a load. So you only really invested 4,800. Same number of shares. Well, no, not same number. 10 shares less. Same price though. Your price though 5,280, and your return went to about half because of the load. So anyway, over time it'd be even worse. Expense ratio. So you have to kind of compare apples to apples here. You can look on the different mutual fund type things, and we'll take a look at some of the sites. But expense ratios, it all kind of depends. It's like a sports analogy. If some coach is getting paid $20 million a year, but his team wins the Super Bowl every year, well, maybe they're earning that. Maybe that money is well spent. Maybe we'll exceed this ratio, which is fine. If I'm making 15-20% on the mutual fund and the expense ratio is way above average, I might be perfectly happy with that, because even when you subtract out the expense ratio, we're doing fine. If I'm getting if I'm just getting average returns, but it's a huge expense ratio, then we got a problem. Why the expense ratio? Now, if you go to an index fund where it's just a buy and sell thing, there's a bunch of purchases done when the fund's created, and then after that it's just admin. No need for any high-powered talent here. No need for a bunch of extra fees. Well, then, if that fund's doing well, it's going to be doing even better, because you're not going to be subtracting out, 1.5%. You'll be subtracting out a very small percentage. And so in an up market, like a bullish market, it sometimes can be pay to have a just straight index fund. We'll look at that, and there'll actually be a little bit of a homework assignment on that. Okay, relationship forms, and that's what I'm saying. Now, this is a broad statement that's with lower expense ratio, all things being equal, but no, the reason you might have a higher expense ratio is because you've got some, cliche rock star friggin' advisor. I mean, you just want to make sure that it's worth it. I mean, people will talk about, CEO performance, these guys. My old college roommate, he worked for he was the president of Raytheon. Talk about stirring napalm. But anyway, this guy made $5.3 million a year, and I guess he was worth it, because that's what they were paying him. Raytheon did pretty well, and so was he overcompensated? It's hard to say. If Raytheon's not doing well, not only does he not make money, but the employees, the stockholders, everybody else loses as well. So perhaps you want to, whatever. It's a competitive place out there. If my buddy wasn't working for Raytheon, he would have been working for somebody else. So that's somebody else. If they're willing to pay him, $7 million a year, he might have got hired away. So it's anyway, a lot to it. Types of stock mutual funds. So mutual funds, it depends on the underlying companies, right? Now, a growth fund is what I've always gone for growth. I'm looking for companies that I didn't do that. Let it roll on me. Companies that are growing, right? Now they're not going to be paying me money in terms of a dividend because they're getting their profits and they're reinvesting them, expanding, and they're doing all that kind of stuff. Growth funds are typically a lot more volatile, but in an up market, that's kind of where I wanted to be. Capital appreciation funds, again, we're not going to, we will talk broadly about this, but you'll see these names change based upon marketing because, again, these guys, there's a lot of competition out there. There's more mutual funds out there than there are underlying stocks. There's more mutual funds than there are individual companies listed in the bigger exchanges. So it's very competitive in the mutual fund business. I mean, if you can become a mutual fund manager, you just take a cut every year out of your assets under management. It's a very good gig if you can pull it off. So there's lots of mutual funds that have been started. And so here's a capital appreciation fund. They're saying that mutual funds, that stocks are expected to grow at a very high rate. Explain to me how that's different than a growth fund. Not really. The big division on most mutual funds are growth funds and then income funds. Income funds are their larger, more mature companies that aren't growing so fast, and so when they make a profit, they're not putting it into expansion. They're paying it back in the forms of dividends to the shareholders. So that's an income fund. We can make a lot more, divisions. We can make an infinite number of divisions explaining different mutual funds. But the broad classes, if you had to just divide it into two, I would say it's growth and then income. And, theoretically, somebody like myself who's getting older should be in an income fund because, I'm relying upon that income. But to tell you the truth, I'm not relying upon the dividend. I'm still, as greedy as I ever was, and I'm more into the growth. So these ones would be, so this, again, if we draw the line right here, this would be the growth, and this would be income, which will make sense as I go through it. So here's a small cap, relatively small capitalization, the amount of money. There are broad classifications if a corporation has this many millions or billions, up to that limit, they're a small cap. Mid cap is defined. It's not really that critical to what we're looking for, but small and mid caps are looked at as probably potential for higher growth, and that's why they've got small, mid, and then they say income or equity income. This would probably actually be categorized as a large cap. A large cap would be, an older, more mature company. An equity income fund. So equity means, just corporations selling stock. Income, and we'll find dividends, right? If you see income, you will see dividends somewhere in there. There's two ways to make money on shares. The way I make money typically is on growth. So, you buy the stock for $20, you sell it for $35. You get a capital gain. On an income fund, you can buy the stock for $20 and sell it for $20, but you got your annual dividends, which you were happy with. Say there was 8% dividend. You got that money in that form. Now, you can get both. You can have one of these equity income, but typically not going to grow as fast. But, you bought it for 20, you sold it for 25. Doesn't seem like a lot of money, but you add up all the dividends you got over the years. That was nice, and that's how you do it. Balanced growth. So anyway, it'd be nice to have that. Balanced growth and income. But it's balanced, so it's going to be, mitigated a little bit if they're trying to shoot for income, they're going to be these larger companies that are probably not going to have the explosive growth. Now, funds can also be in sectors, and the sectors can. This is what I was talking about, where you think for some reason the semiconductor industry is gonna go, and so you want to be in a sector that's got high tech, and you want to be in healthcare, you want to be in defense. You can find a mutual fund that's going to be in any one of those categories. I have gotten burned so many times in medical mutual funds in the medical sector, health devices, whatever. I have no aptitude for that, and it's volatile because one drug will be highly rated, and all of a sudden it fails a trial and it's worth nothing. So I find biotech, medical, all that stuff to be just something I don't do. Technology's always worked for me. Anyway, mutual funds, technology based. You can pick the sector you want, and also we can, I don't know if they're going to do this. Yeah, okay. So I would also, when I think sectors, I also think geographical sectors. You can pick a fund based, I want to invest in like I say, Vietnam, Cambodia, something like that. You don't want to go to the Vietnam exchange. I'm sure they've got one, but my God, the lawyers, the compliance, the transaction, the currency risk, you would, too many things to gamble with. But do they have a representation on the U.S. market? Yes. So I'm looking at buying a company that's listed on the Japanese exchange. Do I want to buy on the Japanese exchange? No, it's a Japanese company, but they also have a presence in the U.S. that they sell, and that's, their lawyers, their accountants, they figure out how to get it listed on the U.S. exchange, and I don't have to deal with all the foreign issues. Index funds. So I talked about index funds, mutual funds that attempt to mirror. I mean, it's more than an attempt. They just, if you're the S&P 500 index fund, you buy 100 shares of every stock that's listed on the S&P 500, and you label it the S&P index fund. You just created an index fund, and when the S&P goes up, so does your index fund, because it's entirely representative of the S&P 500. So you could do that. A computer could do that. A monkey could do that. So that's why the expense ratios are quite low. And sometimes, because of that low expense ratio, if everybody's getting 10% and the index fund has a expense ratio of 0.0 something, and the managed ones have an expense ratio of 2%, well, yeah, if everybody's getting 10%, that one with the 2% expense ratio is only getting 8% in net, and the other one's getting more. Socially responsible stock funds. This can get a little dangerous. You're trying to do the right thing, but are you? It's just, again, I mean, I've shown myself as being fairly not worried about that. I may have offended some people by saying I openly invest in Tesla, but I can separate my emotions out from whatever. And whatever. In this case, they're in compliance, so there you go. But you can invest in things that might be selling, carbon credits or something like that. The reason why I say this is dangerous is sometimes, you get some greenwashing effects where, are they really doing the socially responsible thing, or are they just making it look like that? I mean, it's like watching a Subaru commercial, where it looks like they put a badge on a Subaru saying it's a zero emission vehicle. Let's be honest here, and nothing is zero emission. That, even if it's an electric Subaru, all that energy is not coming from a solar plant somewhere. It's maybe someday there'll be that sort of thing, but you basically have a coal-fired Subaru. And anyway, so there's a lot to this. You have lots of choices. Now, again, I'm not some earth rapist here. You can find stocks or certain companies you don't want to invest in, and there are fundamentally, valid reasons for some companies to kind of be on your blacklist. Not only because they're not socially responsible, but more importantly because they're horrible investments. If you have a corporation that does some environmental damage and treats their people like crap or does whatever, that will catch up with them, and that will be a rotten investment for you to have. So, but ones that are just labeled as being responsible, that's where it gets kind of dicey. Companies that engage in nasty business practices. There's a company called Union Carbide. You probably don't hear about them anymore. They were building, Union Carbide used to build batteries and stuff, and had Bhopal, India. You can look it up. It was, they weren't very compliant with the safety, but what the hell? They're these other people that we don't really know about. We're not going to conduct our business like that in the United States. But hey, it's India. Let it go. And yeah, people died. And so maybe I'm oversimplifying that situation. But if you had Union Carbide stock, you got clobbered. And so there's, these things work themselves out. Companies that want to thrive and want to do well are socially responsible because it's bad business not to be socially responsible. So. Other types of funds, small cap. I mean, they can just divide these things up. Whatever you want to hear, whatever will get you to invest, they're going to label a fund like that to make you enticed to get it. Exchange traded funds, ETFs. This again is it's sort of a division without distinction. It's what's happened is mutual funds, because of their popularity and because of the technology and the availability to trade them just like stocks, ETFs are out there. And these ones, they're traded on the exchanges, and it's not a huge difference. But unlike, say, some of the mutual funds that aren't meant to be traded off and on, these guys can be traded quite quickly. And it's just, again, if you want to go on the stock exchange, and I'm invested in some crypto type ETFs because a lot of times, in most cases, you let's say you have a 401k, you want to buy Bitcoin directly. There's not a provision to do that, but you can buy the Bitcoin ETF that is comprised of that. So you could get on there and buy, Grayscale Bitcoin Trust. It's nothing, but there's a ton of them. It's caused kind of an explosion in investment in the crypto world, and those are all under the ETF banner. But not a huge deal. They're essentially like a mutual fund, just a different place it's traded. Okay, so if you want to look and get more information on mutual funds, how it's done, you would go to the different sites. So I just pulled up a couple here. We'll take a look. There's I just sold this little horse this week. So you can invest in other stuff, but this is more like a leader or a follow-up type thing. All my hogs are being sold. Anyway, one of my girls. And then bird dogs. I've always had bird dogs. But I don't know why I've got that one up. Other than, ultimately for investing, that's where you want to be. You can make money on small business, but for most of us, it's going to be mutual funds. So Fidelity, Fidelity is where I have most of my investments, especially when I was, still actively working full-time for other corporations or teaching more for a greater extent. But Vanguard, same sort of thing. Let's look at any of these sites. I could give you a whole list of them: Vanguard, T. Rowe Price, whatever. Generally, these companies are all very well managed. Not a whole lot of drama, not a lot of scandals going on amongst these companies. Most of them are located back on the East Coast, typically in Boston for some reason. But anyway, their websites are you can learn a lot just perusing the website. Products and services. So they've got mutual funds, ETFs, money market stocks. You can buy individuals. You can do whatever you kind of want. They always want to be your one-stop shopping. And then this resources, invest, and education. This is a great place when you're working on your term paper. But any one of these sites will have it. Why we're different. That's going to be a struggle. To tell you the truth, there's not that many differences between the different companies. And if your company, you're working for whatever corporation, whatever school district, whatever, and they say, oh, okay, we have our funds done through Fidelity or Vanguard or BlackRock or whoever, you really don't care. But for ease of your life, you would probably want to have your own personal investments managed, or have that account with that same company just to minimize your mail or your transactions at the end of the year when you're trying to do your taxes. Mutual funds. View all Vanguard mutual funds. Now, Vanguard, you can see all these ones that start with a V. Those are their own funds. Now, obviously, they tend to make a little bit more money on their own products, so they're going to feature all those. But if you want to buy, somebody else's product, they'll sell it to you because they want to, be your one stop. They don't want you buying a few shares here and then going over to the Fidelity side or the T. Rowe Price side or the whatever side. No, they'll sell everybody's. So here are mutual funds and ETFs, asset classes. So let's look at this. Stocks, fixed income. So what's under these mutual funds? Like I said, they can be made of a bunch of things. Fixed income, so those are going to be ones paying dividends. Money market, balance, sector, specialty. Again, you spend an hour or so on here, and you can get some information. But they should have. I want to see where they're selling everybody's. They should not make a liar out of me, and I don't think they will. I think you could buy. Well, we'll look around at some of these other funds first. I'll look at mutual funds. This is on the Fidelity side. Why choose? Again, it's all marketing. They're going to try and get you to go a certain direction. Environmentally responsible. Here they're calling it sustainable. Environmental, ESG factors, environmental, social, and governance. Thematic sector investing. So I can't give you specific categories other than growth and income and a few of those, because they're going to interchange. I'm talking about socially responsible. They're talking about sustainable. Kind of the same thing. We did both use the term sector. Here, consumer staples, healthcare. God, go figure. It's always taunting me. Or like defense. They don't have that listed out here, but oh man, you always think, oh, there's something coming on. Like right now, the European stocks are, I hate to say it, but those guys look like they might be going to war at some point, getting ready for a 2030 big deal, and the European defense stocks are surging. But I typically don't invest in defense stocks because I don't find them being as vibrant, as fluid as tech stocks. Let's look at some more here. Now this is more in the retail type stuff. Let's get back to products. Okay, so they'll have different things to kind of guide you, different sectors. Over 10,000 funds from Fidelity and other companies. So they're more upfront. They're not really going to try and specifically put you to one fund. And then this is also good. This is kind of why I like Fidelity. The Morningstar, highly rated. Morningstar is a third party that now they've kind of gotten into selling some of their own stuff. This is Morningstar. Morningstar started out as just rating other people's products. But when you're trying to compare mutual funds, Morningstar is kind of where you're going to look because they do the ratings. And especially now, if they're rating their own product, yeah, there may be some bias. But if they're rating the difference between, different funds, then that's more important. So, again, here they're calling it sustainable. I think socially responsible is out of fashion. Alternative investments, markets. Anyway, what you would do is you would look when you're trying to decide on potentially a mutual fund. You would decide, or one of those components would be to look at its Morningstar rating to see, what Morningstar thinks of it, the best dividend funds. And so, 16 best, so a range of companies, and, what is the criteria they're using. And you can see these come from a broad range of companies. So we were already looking at Fidelity. Here's quite a few Vanguards. There's T. Rowe Price, who I talked about. Wisdom Tree. I mean, there's a ton of funds out there. Let's look at this one. High dividend. So we know that's going to be income stocks, right? And Morningstar likes them. Obviously, all the different stars there. I'm going to copy that ticker symbol. And it'll tell you a little bit about it, and then you would compare it to the other mutual funds, so you could kind of come up with an idea. Let's search something. That's that ticker from the Fidelity site. Now, obviously, they gave you the Fidelity one, but then they put in one of their Vanguard ones, and sure enough, I can buy that product right here on their site. They're more than happy to sell it to me, although it's from the competition. And it would just be that easy. I don't have an account with these guys, so they'd want to start, get me to log in, set up the account, do all that kind of stuff, and I'm not quite there yet. I'm not interested in another company. I've got, you kind of pick your company and you go with it, because you can get, if you've got good customer service, if they pick up the phone when you call, if they're responsive to your email, if they're, not involved in any scandals, then, these guys are highly regulated, and I'm not here to pitch any particular company because there's not that much difference between them all. Where'd we go? I think we were looking at, was this the Morningstar? Yeah. So anyway, these, you can get an individual subscription to Morningstar, but the data you're interested in, Fidelity, there's other people are going to provide it, because they know that that's kind of a key thing for people, is to see how, what the Morningstar rating is. Now, why would you want to go with a particular company? They'll do their best to pitch that to you, and fair enough. Morningstar, let's go back to this one more time. And so, obviously, they'll have some filters in there, sustainable attributes, whatever you want. But 9,000 funds. This would be fairly daunting. But you can categorize them however you want. Morningstar's got their categories, how they're going to pick them up. The returns, there's always going to be a disclaimer on here. Previous performance is not indicative of future performance, something like that, some caveat to keep them out of trouble. But obviously, this one that, got 24% last year, 18.5. I mean, you're, again, using the rule of 72. The rule of 72 is just a kind of a simple thing. If you get the interest rate and you divide it into 72, your money will double. So if you're getting a yield here that's, let's call it 24%, 24% into 72 goes whatever, not quite 3 times or about 3 times. So yeah, every 3 years you're doubling your money. I could do that. Over the life of the fund, they're getting only 11. These guys are getting 15. I mean, it's easy to get kind of greedy. Now, what they're not showing are some of the, these are the highly rated ones, but just the same, these guys across the board are doing quite well. Let's look at other criteria. I mean, you could look at their expenses, income characteristics, volatility, no transaction fee. Most of them are going to be in that no transaction fee. And one last thing while we're here. I just want to show you, well, they will allow you to do crypto as well, but there'll be crypto. I don't think they're going to be selling you crypto directly. Now, this is going to be even, they've spent a lot of time because they know that a lot of money perhaps is migrating towards crypto. And I wanted to show you, that's our investing ideas. Let's look under thematic. Megatrends, disruptions. I mean, again, these sites you're going to find that they sort of match your investment objectives because they're going to, have something that looks like it's perfectly made for you because they've got this shotgun approach. They know that, there's somebody out there and they're going to have enough funds that one is going to essentially be exactly what you're looking for. So, like I say, just randomly, I mean, I don't have any special affinity towards Vietnam, but I type in Vietnam, and here's international ETFs. The thing with international versus global, there is a distinction. International means anywhere. I'm sorry. Forget everything I said. International means everywhere except for the United States, because that's where we are. If you're investing in the United States, you're not investing internationally. Global fund, although that sounds exactly the same, it is not. Global means anywhere, to include the United States. Now, if we were in Japan, an international fund would be everywhere but Japan, and whatever, you get what I mean there. But international, and they'll have some funds, maybe some recommendations. Here they want to sector you down, but you can say, for one reason or another, I don't expect the U.S. market to do well. I absolutely do expect it to do well, but if I was contrarian to that, I could find funds that invest in other places. So I think we beat that down pretty well. But a ton of information on there, and it's all presented, very well where you can get a good idea. So, Treasury mutual funds, yep, you can find those. You can find ones invested in mortgage-backed securities, corporate bonds, certainly. Since it's coming out of the private sector, you would expect a higher yield. Yeah, so high-quality firms that tend to have a low degree of risk from more established companies. You can find speculative. You can find, ones that are essentially made out of junk bonds. They'll say high-yield bond or something. They're not going to say junk, but they are junk. And here they are. Munis, very little risk, but not so much in the way of reward. Sometimes people do this for tax purposes, but again, you need to be a pretty high wealth individual in a very high tax bracket before a lot of times that makes sense. Index, yeah, you can do that same thing with bonds. There's bond traders out there all earning commissions, and then there's index bonds that are just, they buy and hold. So a little different. International, so international, non-U.S., right? Global, everywhere. maturity classification. So what you could do is there's what they call life cycle funds, and theoretically, again, I violate these rules, and you could as well, but theoretically, you're young and you're supposed to be involved in growth funds when you're younger because they're more volatile and more speculative. And then as you start to get older, at a certain point when you're retired, you should be primarily in income funds, funds that are paying a dividend, don't have much risk to them at all, because even though if the market, say, goes down for 10 years, it'll eventually pop back up. But if you're retired and you're relying on those dividends for your income, you don't want those market swings. You don't want to sit out for 10 years because, frankly, you may not be here 10 years from now. So you want something more stable. So anyway, they'll come up with an account, and they'll call it, whatever, life cycle 2065 or something. And it means, okay, you're set to retire in 2065, 40 years from now, and this fund is going to have you, in some sort of strategy where it's going to be primarily growth funds for the next whatever number of years. And then as it gets closer to 2065, it's going to switch to more conservative, and it's just automated, and people buy it, so they sell it. Return from mutual fund, same as it always was, just like stocks, dividends and capital gains. So most of the time, you just tick the little block that says reinvest, so you don't cause yourself a bunch of tax issues. If you are making some dividends, for most of us, we don't want to get a little check at the end of the year. No, we'd rather have that money put right back to work and not create some sort of taxable event. Just let it roll. Short term, long term, taxes, 15% typically on that. And then short terms, that's at your normal tax bracket. So you can see, jumping in and out can cost you more. Risk for investing in stock mutual, same as it was. It's the underlying stocks. Trade-off. Yep. Now, what you have to do is sometimes people will try to diversify amongst mutual funds. They'll say, oh, I'm going to get this technology fund from T. Rowe Price, and I want diversity, so I'm going to get another technology fund from Fidelity or something. What you're going to find is that the underlying holdings for those mutual funds are usually the same. So you don't really have any, you don't have the diversity you thought you had. Come on. So let's look at it just very quickly. Perhaps I clicked these buttons too many times. It seems like it's not wanting to work for me. Too many open tabs, perhaps. Come on. I guess I'm already there. Was their problem? Let's look at a small cap growth. Now, these may be companies that you may not have heard of, but I just want to look at one kind of in depth here. So here's all that data we were looking at. Expense ratios. So they say the average expense ratio is 1.5. These guys are 0.84. So you go, oh, that's pretty good. You would check and see, what the other funds are like. Turnover ratio, that's how often they flip the assets. So 100%, that's pretty high turnover. But again, look at the relative thing. Here's the fund manager. This is a guy, Google him. How's he doing? What's he been doing? Why is he the one in charge? Mark Groh. What a great name for a guy involved in a small cap thing. But this is what I was going to show you here. In terms of diversification, you go, why do I want to invest in this fund? Well, these are companies that they think are doing super well. I got to laugh. Grand Canyon Education, whatever. I'm not saying diploma mill, but maybe they're killing it. Anyway, some of these companies, these guys have done these research, and this is what they think is doing well. So these are not necessarily the companies you've heard of, because these are in the small caps. This is that prospectus I was talking to you about. This is the legalese, the rules of the road. This is what we can do. These are expenses. This is our strategy. And this is kind of the guidelines, what they've got to do, right? I could compare it to a different fund. See how the expense ratios compare to the other ones. You can look at the growth. I mean, there's just a ton of information. They've already got the Morningstar data for you. The Morningstar ranking. They know you're going to look for that. So it's pretty neat. Let me look at something that's. I'm going to look at a large growth. So blue chip, right? Blue chip is just a adjective to describe the bigger companies. We'll look at their holdings. These are going to be big companies that you are going to know of, right? Yeah, Nvidia, Apple, Amazon. So they've basically got the Magnificent Seven in here. And then a drug company, Netflix, Marvel, Tesla. So there's a lot of information that's out there. The fund manager, this guy, is he somebody I'm impressed by? I mean, you're looking for a way to make your life easier. Find something. You don't have to go out here and chase down these individual companies. And if they think Alphabet, Google does something stupid, it's up to them. It's up to this guy to say, hey, we should reduce our exposure there. That's what you're paying for. That's what the expense ratio is for. Because top 10 holdings, they've already got almost 60% within the Magnificent Seven. If you go to buy some other big blue chip company, you're going to find they also have the Magnificent Seven in there. So the Magnificent Seven is a reference to the stock performance is made. People are going, the stock market seems to be going up. Not all of the market is going up. There's about 7 companies that dominate that are doing really well, and they're dragging the rest of the market along with them. So, and if I had a mutual fund, man, that would be the fund I want to be invested in, those companies that are doing really well. Okay, moderate, high risk, obviously, it's the way it works. Risk from investing in a bond fund, yep, the company may fail, default risk. This is how it should work. So, foreign stock focused on one company, yeah, that could be dangerous. The U.S. market is pretty good. And a lot of times, even if you happen to be in a foreign market and the U.S. market tanks, guess what? That other market will tank because the U.S. is big enough. When the U.S. gets the sniffles, the rest of the world gets a cold, or whatever the expression is. But the U.S. market has a great effect on other markets. Income fund, big companies, less volatile, less risk. Growth, getting up there, capital appreciation. Global stock fund, now you're introducing the international element. Technology is always going to be a little bit more volatile. Bonds, okay, now we're looking at government securities. The government would have to fail, so very low risk. Here we're out here doing these high yield. Yeah, we're high risk. We're buying junk bonds. Easy. Bond mutual fund. Yep. Trade-off between risk of bond funds. So, yeah. Junk bonds, corporate, guys that are already in default perhaps. Conservative, the federal government. Moderate, people's mortgages. People can go bankrupt, can go into foreclosure, but not that likely. And so that's the way it goes. The shorter risk is because this is a shorter commitment, They're not making much of a forecast. So when you're really sticking your neck out for a long, long time, like going long-term high yield, not only are you buying junk bonds, but you're thinking that sketchy company is going to be there for the long haul. Probably not a great bet. determine your objectives, and make money, obviously. Evaluate risk tolerance. Be honest with yourself. If you're going to be one of those people that panics and gets out of the bottom, well, you need to work through that. You need to get over that, because you can't sit on the porch because you think you're taking the conservative approach, but really you're getting clobbered by inflation. And you're going to end up having to work, through your whatever, and then become a Walmart reader at some point, because your savings are not going to have done what they needed to do over time. That prospectus, so we looked at a prospectus. You go more in detail, and it is less into the marketing and more into the fund will do this, the fund won't do that, and it's a legal document. You have to. Back in the day, they had to send you a copy of it. Now, at least you have to acknowledge it. And it's not like some end user, Apple thing where you just tick the block to make it go away. No, this is probably one you actually want to read. Mutual funds. Yep. Super easy to find their past performance. And then, compare it to something else. Compare it to the other fund. Spend a few hours looking through it on a good, broad site that will show you everybody's data. They'll show you the Morningstar data, and then make your decision. Back end load. Sometimes, if they want to take a load and it's on the back end, not nearly as bad. That means they got skin in the game. You make $1 million on the fund, and then they take a percentage on the end off of the winnings. If you don't make any money, their back end load is affected. Some of these other guys, the salesmen, they sell you the product, they made their money. They don't care whether this thing makes money or not. They've got their money, and their money's not affected by the performance. If it's a back end load, yes, it is affected. Risk. Distribution of capital gains. Generally, reinvest. Minimum investment, everything's waiverable. And if you set up a automatic deposit with just a small amount, people are super easy to deal with. You'll forget about it. The money will just grow and grow and grow. And next thing you look down and go, wow, that's impressive. So making a decision. Yep. Yeah. Over those tables. Yeah, Fidelity. We looked at Fidelity already. Quotations. Well, we're going to use charts. The tabular data is just not the same. This is how it's going to be presented. It's not nearly. You can take in so much more information, and this is what makes retail investors. It's so much more powerful. And type of index, closing. Yeah, we can figure all that out from a chart much better. There is this Mutual Fund Education Association. But the websites themselves, they're not too oppressive, other than wanting you to log in, them wanting to get your email. But they're generally, they're you all as people just entering the financial world. They're going to do their best to make you one of their customers. You're not going to get them a whole bunch of money in the short run, but in the long run, you are their future. So those websites are going to be set up to attract you, and you can go to this site if you like, but I think the regular websites are not too bad. Diversification. Talked about diversification, why you want it, but make sure you actually have diversification, and you just don't have a bunch of different mutual funds with all the same underlying investments. Impact of the financial crisis. Write it out. Be disciplined. Don't run yourself into a corner where you need to start pulling that money out. If you do, that's fine, but that's not the plan. And don't do it based upon, oh God, the market's going under, and no, everything will be fine. Look at the, zoom out, and you will realize that volatility is part of the game. International, you can do it, just don't do it just for diversification's sake. If you're driven, if there's some reason Like the Indian market, people are talking about how great it was going to perform. It didn't perform that well this last year. Um, the Chinese markets, you can get some exposure there, but again, there's other factors, and I used to own BYD back in the day, and a few other different Chinese investments, and the U.S. is pretty good. I would be hard pressed to think where I'd want to invest too many times in foreign exchanges, but it's up to you. Future month, we've seen that you can buy. Everything is kind of a supermarket. You can get what you want from basically any company. Variations, mutual funds. Yep. So, don't trade on foreign exchanges. You can invest in foreign markets if you want, but believe me, I ended up with some investments in, I believe it was some in Canada and other places, and oh my God, the paperwork was just a nightmare. Hedge funds is just such a broad term. Hedge funds are actually mean they're like contrarian type things. Like you've got a bunch of money, you're afraid that it's going to go down based upon something, so you hedge it. You make a counter investment that is related. You go short in another market, and you do that with options. And so if the market goes to crap, you sell the options and you make your money back. Hedge funds now they've sort of changed the definition, where it's just what the wealthy people do with their wealth, and it's just types of mutual funds that are typically very actively managed for certain people, and anyway, tend to take more risk, tend to use more unconventional investment approaches. Bernie Madoff, yeah, he was a scammer way back when. There'll be another Bernie Madoff. This guy, he was just flat out running a Ponzi scheme. This is no reason not to invest. These people, by these people, I mean the people who invested with Madoff, they were getting like 17% a year, and they experienced no risk. That's not possible. They should have known. Turns out Bernie was just taking the money, and then he was paying it off to other people, to new investors. And so those great returns were not actually coming from the investment, his investment prowess. He was just a scammer. Those people exist. They'll always exist. Just make sure, if you're getting great returns, make sure that it's logical, that the underlying securities are going up. If people would have done any bit of due diligence, any bit of research, Bernie would have been found out long beforehand. But people were getting 20% and they were happy. Homework. Okay. So this is just one thing to show you kind of about like tax, munis and stuff. When I said people will invest in that, you can kind of sort of do this in your head. Which investment do you want? 10.2% tax exempt, or 7.9 tax exempt, or 10.2 fully taxed. So if you know your tax bracket, let's say your tax bracket is say 30%, all you would do is you just multiply this by 30%, 0.3, which is a couple 3. You subtract that from your percentage, and now you're down below 7.9. So anyway, just know your tax bracket. In this case, they've given it to you as 28, so meaning that you get to keep 72%. So 10.2 times 0.72. If it's a number less than 7.9, then you don't want the taxable one. If it's a number higher than 7.9, then you do want the taxable one. Here's one where you buy and sold. There's a commission, so that's going to come off of your profits. You got a dividend, so that's going to be added back into your profits. Figure that out. Interest in the economy. Yep. What will happen? Market value, fixed interest. Yep. Easy. 20 years ago you've been investing. How much is it worth now? Yep. Podcast. Okay, so we talked a little bit about index investing, and we talked a little about more managed funds. There's always going to be debates on what's better. I've got a podcast out there that's getting old. It's damn near 9 years old now, but it's still super valuable. The people are still out there. Warren Buffett and the Vanguard guy. Still same people, still having the same argument. But this thing goes through on an NPR kind of podcast thing and discusses the different strategies and a little bit more in depth than I can here in this class. So you'll just put out a page summarizing the bet and what do you think of the two different strategies. Finance, the term paper. So those sites, Fidelity, Vanguard, T. Rowe Price, any one of these big companies, go look at them and start developing your paper. Not that hard. Just the first step is the toughest part, and then you're in the term project. You'll do well. And I think that's about it. Yeah. Any questions on that? I don't think so. Like I say, you're going to be involved in mutual funds. Embrace it. It's fun. It's easy. And that's really where you're not obsessing over stocks. If you want to engage in buying individual stocks, more power to you. But for most of us, mutual funds ought to be where the bulk of your wealth is. Good luck.